you can use an iron fly anytime you think that it has a strong possibility to stay within the expected move. It doesn't only
Oh,
have to be earnings, it can be any time frame, right? But if
yeah.
you believe it can have the potential to stay within the expected move. So this is the iron fly that we set up this morning for Zoom, and Zoom
Mm-hmm.
comes out with earnings this afternoon. So, what an iron fly is, let me kind of break this down, everyone. An iron fly or iron butterfly, right? It's doing a straddle, right? It's selling the straddle, and a straddle is when you basically the traditional standard straddle is when you sell the at the money put and call, right? Or you can buy it, but in this case, obviously, we're selling it. Okay, so if we sell here that by clicking on the call side at the bid and then selling here by clicking on the put side at the bid, this is a straddle, right?
Mm-hmm.
And a straddle is basically the expected move, and you make money if it stays within $11.50, right? So this is the straddle. This is what TastyWorks is saying the expected move is about a little over $11, right? So because you're collecting 11.50, if it goes up only $11 or if it goes down only $11, then you're gonna win, right? As long as it don't go more than 11.50, you win on this type of trade. Okay.
Mm-hmm.
Now, but you have unlimited risk to the upside when you do a straddle, right? You have unlimited risk because it's naked, right? You have a naked put and a naked call. Well, the naked call has unlimited upside, risk. And on the put
Mm-hmm.
side, you have risk all the way to zero, right? Because you can't go
Mm-hmm.
past zero. So
Right.
to change that, what you do is you buy the wings, and that's where the butterfly turns into, right? So this
Right.
is buying the wings of the expected move, right? So this is the body of the butterfly, and this is a wing,
Mm-hmm.
and then over here is
Right.
another wing. So
Right.
this and so what happens then, patients and everyone on the
Mm-hmm.
call, is that you want it to stay within this range
The
here,
expected
right?
move.
So if
Right.
it stays in that range still of how much you receive, then you
Mm-hmm.
win. So in this example, this range is 7.90, almost $8. So if it stays within
Mm-hmm.
7.90, you win. Um, and
Mm-hmm.
and go to the graphic here if we can see it. This is the iron fly here. This is the at the money
Mm-hmm.
line. So you're selling those that naked put, naked call, and then you're buying the wings here. You're buying the put here, and you're buying
Right.
the the call there. So you really want it to stay within a range, right? Because if it stays
Right.
within a range, that's where you win.
Mm-hmm.
That's your win zone. But if it goes down too much, you can lose. If it goes up too much, you can lose. But your loss is defined in this scenario because of these wings and how much you collect. So the
Mm-hmm.
most you can lose in this example is 310, 315. Okay. So
Mm-hmm.
if I just say, for example, you do this earnings play and for some reason Zoom goes down way too much or goes up way too much, well, you know that okay, you didn't have unlimited risk to the upside or risk all the way to zero. You only have 315 of risk. Okay.
Mm-hmm. Okay.
So,
And so my
so
mind tells me that, if somebody were to research those stocks that really don't move too much, I
mhm.
mean, and don't have too many traders trading it, that you might be able to, predict on how much control you may have about, on the expected move. Won't you say that?
So, well, if it's not a lot of traders who trade it, then it might not be easy to get in and out, or at least out. So that would be a negative. But you, the reality though, patients, that might be the case, right? You can test those out, but keep in mind you want to make sure it's the options are liquid and you can get in and out.
Okay.
But
Okay.
all stocks, all stocks that based using this Black Scholes type of option model, it's going to 68% of the time, one standard deviation at a time, stay
Mhm.
within this range at
Okay.
expiration, right? Doesn't mean
Right.
it can't go outside of this range,
Mm-hmm.
but at expiration, it's going to be in this range. So,
Okay.
and with this type of trade, we don't want it to ever go outside of the range.
Mm-hmm.
So what we're trying to do is not get this max profit, in my opinion, patients. We're not trying to get this 780 max profit. We're
Right.
trying to get about 25% of that, because then
I
that would
see.
allow us to increase this probability. I believe this probability can go up to 55, 60% chance
Okay.
to win on this trade, because iron flyers are not high probability trades.
I
Usually the
see.
structure of an iron fly at best is 50-50 at expiration, usually
Mm-hmm.
less than that. But if you get out at like a profit range of 25%, you can increase your probability on these
Mm-hmm.
iron flies to over
Oh,
50%, and that's what you want. So
okay. Great. Thank you.
you're welcome. You're welcome. So great question. I appreciate that one, because
Mhm.
this is an interesting strategy when people see it, but it can be a little confusing initially. But it's basically, everyone. It's basically a an iron condor that's structured differently, right? An iron condor,
Mhm.
you inherently neutral.
Mhm.
You want it to stay within a range.